The dollar's getting stronger for some very bad reasons, meaning bad in terms of the macroeconomy, what probably lies ahead, what is probably telling us. But this is a conundrum for a lot of people because they look at it, the U.S. objectively, okay, our debt to GDP ratio is over 130%, highest in U.S. history. Tons of research coming from obviously Ken Rogoff, but really Carmen Reinhart, Vincent Reinhart, and others, but many others, not just them, that says at those debt to GDP ratios, you can't grow. You can maybe refinance and muddle through, but it always ends either in default, which is unlikely because we can print the money, that much is true, or extreme inflation where here's your $1 trillion back, good luck buying a loaf of bread. So
despite America's high debt to GDP ratio and weak economic fundamentals, the US dollar remains strong. Jim Rickards explains that this strength isn't about economic health. It's about demand for dollar-denominated collateral in the global banking system. Non-U.S. banks scramble for short-term U.S. treasuries to back over $2 quadrillion in derivatives. Meanwhile, printed Fed money often sits idle as reserves, never entering the real economy. The real monetary engine is commercial bank lending, M1, not M0. With the Eurodollar system recycling capital endlessly and global dollar shortages mounting, the dollar's strength is rooted not in prosperity, but in systemic plumbing and collateral demand.
We'll see how that plays out, but the way it's playing out in real time is that the U.S. Economic growth is incredibly weak. So we've got sky-high debt to GDP ratio. People talk unemployment close to an all-time low. Yeah, but even at 3.5% or so, that is extremely low. I mean, I go back to the 1960s, and that was low by the measures of the 1960s. But that completely ignores probably 8 to 10 million Americans who were perfectly able of having jobs and working, prime age 25 to 54 years old, who are not in the workforce. That measure is picked up in labor force participation rate, which is low. I mean, that peaked around 70% in 2000, up from the 1970s, and that was women coming into the workforce and other factors. But now it's down to around 62% and change. It ticked up a little bit in the last report, but it's still extremely low. It's never 100. I mean, there's always, you could be a homemaker, a student, they're retired, early retirees. There are a lot of reasons people aren't in the workforce, but not taking 10% off or 14% decline from the starting place in over 20 years. So if you throw those people into they're not called unemployed because they're not looking for jobs, but if you threw them in, unemployment would be closer to 10%, which is a recession or a depression level, actually. So, and I could go on, but the point is there are all kinds of signs of weakness. So, I forgot the deficit's out of control, and your trade deficit's out of control. So what's not to like? You look at all that, you say, what, are you kidding me? I mean, get me out of the dollar, go get anything else. Why is the dollar so strong? And the answer is, for this, you have to go behind the curtain. You have to look into what's called the plumbing of the international monetary system. And I had a discussion, and this goes back, this is 1980. So I'm an young, up and coming vice president of Citibank. That's back in the days when it was a bank before they turned it into a hedge fund. I'm like a 27 or whatever, a 28 maybe year-old lawyer, but I'm talking to Walter Wriston. It's a one-on-one conversation. He was, for those who don't know the name or don't recall, he was probably the second greatest banker of the 20th century after Pierpont Morgan. So I'll give Morgan the prize, but he left around 1910. And Wriston was the inventor of the Eurodollar. So the negotiable certificate of deposit. Eurodollars are around a little bit earlier, but he took the CD that was your interest in the Eurodollar and made them negotiable and tradable. So I'm having a conversation with him, and I had just seen this movie. It's called Rollover. And it's, again, 1980. It's basically about the collapse of confidence in the US dollar. And basically the idea was, remember, this is during the Arab oil embargoes and the Iranian oil embargo, and price of oil quadrupled in 8 years and all that. So the theme was the Arabs are taking the money out of the banking system and buying gold. and they're stashing the gold away. And this is the collapse of the financial system. And that was sort of the plot. So I said, hey, Mr. Riston, what about that? Everyone took their money out of the system and bought gold. Wouldn't that collapse the system? And he looked at me like I was a new kid on the block, which I was. And he said, well, what you have to understand is that you can take your money out of the bank and you can buy gold. But the person who sold you the gold got the money and they put it back in the bank. So it doesn't go anywhere. It's a closed circuit. And of course, now I'm like, oh yeah, you're right. Of course he's right. And he said, so the stability of the system doesn't depend on who sells what for dollars. Yeah, it affects exchange rates a little bit and interest rates with the price of gold. But he said the money always, it can't literally disappear. It has to go back into the system. It's a closed circuit. And of course, that's how the Eurodollar system works. But it presupposes that you can always borrow in the Eurodollar market. In other words, that closed circuit analogy is correct, provided the big banks are willing to lend to each other. So if my example, if UBS was selling the gold and to the Arabs and they got the money and they put it back in Citibank Nassau, it's all good. But what happens if that money supply, now I'm talking about Eurodollars, actually shrank? And that is a heart attack in the global financial system. So now we're like, well, okay, what's going on? And believe it or not, there's a global dollar shortage. And when you say that, people say, wait a second, you kidding me? The Fed printed, the Fed's balance sheet in 2008 at the start of the global financial crisis was $800 billion. It was $4.5 trillion by the time we got to the end of the taper in November 2014. Then, okay, Yellen a little bit, but mostly Powell got it. They started quantitative tightening. They got it back down to around 3.5 trillion by the time COVID came along, and then boom, it's up to 7.5 trillion. Might have gone higher than that, and that's M0. M1 was exploding even more. So how could there be a dollar shortage? And that has a two-part answer. One is the money printing, at least M0, is irrelevant. It just doesn't matter, because how do they print the money? Well, the Fed buys securities from the primary dealers, and I was, after I left Citibank, I joined one of the biggest primary dealers, and I was there for 10 years, so I had a front row seat. That was back in the days when the Fed was actually tough on people. But my point is, I was a counsel of a primary dealer. We talked to the Fed every day. And so the primary dealers are the ones where the Fed open market desk, the New York Fed does monetary policy. They buy, so they call up Goldman Sachs or Citi or whoever. So offer me, 5-year notes or 2-year notes or whatever. Here's a price done. The banks send the securities to the Fed, and the Fed pays for it with money that comes out of thin air. But here's the part that matters. What do the banks do with that money? They give it back to the Fed in the form of excess reserves. The bank deposit at the Fed, in effect. So that money never went anywhere. It was created. It is on the balance sheet, but it all went to the asset side, which were securities, and it never went into the economy. So where does the money come from that runs the economy? If you or I want to go shop, well, it comes from the commercial banks. It comes from M1. Yeah, there is a multiplier, but that's in M1 and M2, which is created by the banks at will. And the Fed, those commercial banks have as much printing power as the Fed. They just do it differently by lending money or buying securities and paying for them with money that they create. So, and that never happened. It happened to some extent, but not nearly to the extent that what the Fed was doing with M0. So M0 didn't really matter. I mean, I hate to break it to people. Commercial banks do matter. Eurodollars do matter. That's how we run the system. People say, well, how can you have a dollar shortage with trillions of dollars of new money? You have $1 quadrillion of derivatives in the banking system as a whole. So that slice, whether it's the 7 trillion of M0 or a larger number, perhaps 24 trillion of M1, that has to support $1 quadrillion of derivatives. And by the way, for those who don't know, a quadrillion is 1,000 trillion. That's what a quadrillion is. So now it's not dollar for dollar. Jamie Dimon would say, well, who cares? Just put up a little collateral. But you have to put up some collateral. And then you get into the collateral issues. Like, well, what's good collateral? The answer is, and this is what the banks are saying to each other. And this goes back to my conversation with Walter Wriston and the movie Rollover and all that. The banks are, and in fact, what happened in 2008, the banks are looking at each other saying, I don't want your corporates. I don't want your mortgages. I don't even want your 10-year notes. Give me, at a stretch, I'll take a 2-year note with a haircut, or what I really want are 30, 60, 90-day bills. I want treasury bills. And so you got to go out and get the treasury bills, and they're dollar denominated, which means you need dollars. So if you're Credit Suisse or Barclays or Hong Kong, Shanghai or Deutsche Bank, you don't live in a country that prints dollars. The US does, but the European Central Bank doesn't. So there's this enormous demand for dollars, not because they love the dollar, but because they need to buy dollar-denominated collateral of a very high quality in order to pledge as collateral to support the quadrillion derivatives position, and plus any other trading they're doing. And so that's the clue. That's the secret that unlocks, or the key that unlocks the whole mystery, which is, it doesn't matter what the debt, for now anyway, it doesn't matter what the debt to GDP ratio is, the deficit is, the labor force participation rate, the weak, none of that matters. What's going on, not in M0, but in M1 and euro dollars in particular, is a mad scramble for dollar-based, high quality dollar-based collateral. And that's what's driving the dollar.